We need to focus on the global economy, on central banks, and we can do that with Rick Lacaille. He is at State Street Global Advisors, our Chief Investment Officer. Rick, thank you so much for joining us. To walk away from Brexit here for a moment, we see dampened inflation in Japan, the economic data out of Germany, really soggy, the challenges here and around the world as well. How is State Street Global Advisors adjusting to the new reality of a global slowdown?
Yeah, the new reality is we're expecting growth next year about 3.5% global growth, so a little bit below trend. But we are still expecting growth. We're expecting unemployment to remain low, inflation to remain contained. And for that reason, we remain with somewhat of a risk-on position. So to be sure, we've had volatility in the fourth quarter and people reassessing a recession risk. But we don't think the recession risk is high.
Okay, well then linking that into the politics of the moment then, you're talking about a dampened nominal GDP, a dampened business animal spirit. Francine and I heard the uproar of British business over what happened in the last 24 hours. With that said, what will governments do in response? Do we continue to see populism and revolt, or can we actually see programs to jumpstart or reflate the global economy?
Well, you shouldn't forget that we've had a pretty buoyant economy from an employment perspective in many parts of the world. It may be the case that a narrative has developed that people are challenged, but unemployment's come down in the US, in the UK, it's at very low levels. Even in the Eurozone, outside of the South and in the youth employment market, we've had pretty buoyant conditions. So I think the populist argument's not all about people struggling, it's about other things as well. And I think politicians will continue to struggle. That creates risk for investors because globalization has been a real fillip for us. And if the brakes are put on that, that is damaging to future profits.
Rick, let me ask you about Brexit. What do the markets want? Would a delay in Brexit or would a delay beyond March 29th be a good or bad thing, a positive or a negative for the markets?
I think markets may have become too optimistic about the prospects for Brexit. If the consensus is we now kick the can down the road and eventually end up with a deal, that neglects the possibility that kicking the can down the road allows those who say we should prepare for a no-deal Brexit a little bit more time to make that preparation in the UK. So I don't think it takes no deal off the table at all. In fact, kicking the can down the road may actually increase the possibility of a no-deal Brexit, even though parliamentarians don't support it.